Hey, what's up, y'all? Happy New Year. We are at the beginning of January 2022. And a lot of people have been asking what are going to happen with mortgage rates in the next year. So I have created this 2022 market forecast that's going to talk a little about the trends that are going on in the housing market, and more importantly, how that's going to affect interest rates as we move forward in the new year. So you can make an informed financial decision on what you want to do with anything you're doing real estate related, whether you're buying a house, selling a house, or if you're just curious. So let's get rolling with the 2022 market forecast. And I'm going to pop over, we'll put it over in this mode so that way you can see a little better. And so before I get into this, I want to let you know that this information is provided by Barry Habib from MBS Highway. And I do tell you that because, you don't think that Carlos is making this stuff up. MBS Highway and Barry, they're professionals at creating content and, doing insights and understanding the marketplace to understand exactly what's going on with the market. And so, it's just not just Carlos, the loan officer, talking smack. These are actual things that have been researched, and you're getting the most up-to-date and current and expert information. So on that note, let's hop into it. So first of all, interest rates. What was the forecast and what was actually happening? So in 2021, the forecast was expected rates to rise a little bit and then recover into the fall. And in actuality, rates did rise sharply through March as anticipated, but they did recover a little bit as expected and giving back most of the losses by late summer. And as for housing, strong demand and tight supply was predicted to be a huge thing, pulling up housing by single digit percentages. And in actuality, there was a very strong demand and tight supply, and COVID caused supply chain disruptions and labor shortages, which pushed real estate prices much, much higher. So 2022, what do we have to look forward to this year? Or do we have not to look forward to interfere this year, I should say? So some things to look at are tapering, rate hikes in the balance sheets from the federal government, from the Federal Reserve, I should say, and that can impact equity markets and drive the rates up. And 2022 composition will be less accommodated than 2021 because now we got this inflation thing going on. So fighting inflation is going to be a huge focus going into the year. And it could cause problems with the stock market. So be careful there. And the Fed probably should have hike rates sooner. They mistakenly thought this inflation thing was transitory. But history can help us forecast how the Fed actions have influenced the markets. We're going to look at that in a second. So let's do a brief bit of history. I'm not going to go too deep in the weeds here, but I do want you to understand what's been happening. So in the 1970s, a guy named Arthur Burns was Fed chair, and he ignored inflation in the beginning. It was rising rapidly, and year-over-year inflation ballooned from 7% in 1978 to 14% by the time he left in 1980. Yikes. He did remain steadfast, though, that inflation was transient. And what happened was that the mortgage bond investors said, hey, wait a minute, if we have 14% inflation, you can't pay me 7% on these mortgage bonds. I'm losing money here. So that caused mortgage rates to spike from 12% to 18% by the time he left office. Wow. Kind of scary. And it makes you really think about, the way everything's relative. It's very different now. So then we had a guy named Paul Volcker, who was appointed by Ronald Reagan. And his thing was he wanted to really, really fight that inflation that happened in the 70s. And so he hiked the federal funds rate, which is totally different than mortgage rates. People confuse the two a lot. The federal funds rate is basically the rate that the Federal Reserve lends money to banks. He raised that from 11% to 20% in just 2 years to fight that inflation. And it worked. Inflation dropped from 14% to below 5%. And also mortgage rates also dropped from 18 to 12. So that's good. But there were consequences. the stock market drops, and also it caused a recession in 1982. Then we got good old Alan Greenspan, well-known chair of the Federal Reserve, probably one of the most famous chairs. Inflation doubled a little bit from 1.75 to 3.5. And it did cause mortgage rates to rise slightly, but not too bad. And federal funds rate had some changes as well. And as you can see, there was a nice little refi boom. But then, sure enough, S&P fell 50%. And again, another recession. Today, we got Jerome Powell. And inflation has increased from 1.75 to 7%. Powell thought that was transitory. That's caused mortgage rates to rise slightly from 2.5 to 3.375. They are currently tapering their purchase of mortgage bonds. They are done tapering in March, likely to begin hiking rates in May. They're targeting 3 rate hikes in 2022 and 2 or 3 Fed funds rate hikes in 2023. And inflation and interest rates can rise until the Fed acts. If the Fed can time inflation, mortgage rates should drop, but it may be from higher levels. So let's see a pattern here. So on the first guy, Burns and Volcker, inflation 7 to 14%, mortgage 12 to 18, and then there was inflation response, mortgage rates dropped, and then boom, recession. And then with Greenspan, we had some inflation, rates went up. Again, they had the response, rates went back down. Again, recession. Powell, inflation going up, mortgage rates still pretty low for now. Fed funds rate, very, very low. Inflation response, it should drop. It's projected to drop once he does put in once he does have his actions. And the mortgage rate response should decline as inflation declines. So right now we're in an inflationary period. But as the Fed takes his action, then we should see mortgage rates drop back down. But we're also projected to see a stock market drop and another recession in 2023. So there are some wild cards to keep in mind here. One, we got COVID still hanging around. And so that is a major surprise that could change the outlook dramatically. Another impact is additional stimulus. It could push stock prices temporarily higher, could cause mortgage rates to rise further, and it'll make the Fed's job of curtailing inflation even more difficult. And of course, the first step would be for the Fed to stop purchasing new mortgage bonds and treasuries. Next step is hiking the Fed funds rate. And then the Fed's still buying $70 billion a month in mortgage bonds through reinvestments, keeping rates low. And so it could move higher than previously thought. Stock market forecast. Stock market currently forecasted to decline about 10%, but of course, things can happen. There can always be some crazy wild card that could change things, but that's the current forecast. So interest rate forecast. We anticipate interest rates are going to rise during the first half of the year to around 3.75. It's not going to get too crazy. But with the Fed action, softer stock market, slowing economic conditions, looming recession, we should see rates head lower in the second part of the year towards around 3%. So forecast, again, as rates rise towards 3.75 and then decline towards 3% in the second half of the year. And so that's something to consider when you're looking at things that sets a bias of less upfront fees because of a refinance opportunity down the road. So what about housing itself? How's that going to look next year? Well, housing is going to remain strong in 2022, but not as strong as this year because we just had this crazy market this year. So it's going to be really, really hard to sustain that next year. Demand's going to be slightly softer due to a rise in interest rates, but it's still going to be pretty robust as well. Labor supply will increase, but it's going to remain tight. We're still going to have some tight labor, supply chain disruptions, and semiconductor shortages that are all going to play a role in this. And rents will continue to rise. And that's another really, really big factor is, when someone is, oftentimes they'll compare, well, I can buy this house or rent a house, because people buy houses based on payment, not based on price. And if you can buy a much nicer house for $1,200 or just that apartment rent for $1,200 or $1,500, whatever that price is, that certainly keeps people in the market. And so rents are still going to increase above 5% and pushing people to see that benefit of buying. And that's all we have. I hope you learned something with this presentation today. As always, if you have any questions, feel free to reach out. Have a great day. Thank you.